Hey everyone, welcome back to the channel, your number one source for income-oriented investing, how to generate passive income from a diversified portfolio of high-yield funds. And it's time for one of your favorite videos, a very popular monthly video on this channel, which is about to celebrate its 4-year anniversary. I can't believe it. This is episode 47, my monthly series of where I will discuss and review and go over the top high-yield income-oriented funds on both the Canadian market and the US market. So if you're American, if you only invest on the US market, make sure you use the YouTube chapters to skip over the Canadian part. But if you're Canadian, remember to check out both parts because you could invest without any 15% withholding taxes in your RSP, RIF, and Lira and LIF accounts. Very, very important to understand that. So what is this monthly series all about? Well, it's evolved over time, and with the addition of so many funds on income-oriented funds, rather, on the Canadian and US market, I can't just pick and choose a couple that I feel are good buys because there's so many funds now. So what this video is all about is really to give you an update on not only the overall markets, Canadian and US, in the last month, but more importantly in the income-oriented fund landscape. So what I do is I go over some of what I feel are the top income-oriented funds on both the Canadian and US markets, and we'll see if there's any news on any of them, distribution or dividend increases, decreases, any new funds in the market. So think of this video like a monthly newsletter or update on the income world on the Canadian and American stock market. So let's get to it. Let's see what's going on in the income world right now. All right, I'd like to take a moment to thank the sponsor and good friend of the channel, Harvest ETFs, which have just launched HPYM, a brand new fixed income covered call ETF covering US Treasuries, a great complement to their existing HPYT, which they call Happy T, much easier to pronounce that way. So HPYM is medium duration compared to HPYT, which is a long-term duration, so even less risk, but really high yield. They did declare their first distribution at 8 cents a month. So the yield is approximately, based on that number, about 8% based on this price. So very nice high yield for a very, very low risk ETF and asset class, even lower risk than HPYT because it's medium duration. It's 7 to 10 years instead of 20 plus years. And guess what, guys? I just did an interview or a Q&A with Paul McDonald, first time on the channel, CIO, Chief Investment Officer at Harvest. And we talk all about HPYM and also Happy T as well. See why they launched it. What's the idea, premise behind it? Why would anyone invest in HPYM instead of Happy T? So it's a very, very cool Q&A. Make sure to check it out. It will be in an upcoming video in the next week or two. So again, I'd like to thank Harvest for sponsoring this video. And don't forget their all-in-one solution, HDIF, which has the best of, if you will, of their covered call ETFs. Also includes a little percentage in Happy T. I absolutely love HDIF. It's the all-in-one solution that I personally own from Harvest. So now let's check out what the market did in the last month. I am filming this on February the 7th, guys. So just make sure you note that, and the market's still open while I'm filming this. And the American stock market, which in my opinion, the best measure is the S&P 500, has done extremely well in the last month. You see, if you just click 1 month, and by the way, if you just Google SPX, that's the S&P 500 index, up almost 5% in the last 30 days, which is absolutely fantastic. We're hearing brand new record highs, shattering records, the S&P 500, but on the Canadian side, and not really a great story. So this is the 1 month. You see that it's pretty much flat, a little bit negative. So yeah, it doesn't really surprise me. Remember, the Canadian market is very heavily based on cyclical sectors like financials and energy and materials, which have gone down or are still flatlining. So definitely some opportunity in the Canadian market, more in my opinion than in the US market. But it's kind of hard to say that because the US market is just king. As time goes on, I'm gravitating more and more towards the US market myself with my investment portfolio, which you guys know that the other very popular monthly series, by the way, on this channel, in case you didn't know, in case you're new to the channel, is my monthly portfolio unveil, which is also coming up in a week or two. And there's some changes, so you don't want to miss it. So now let's go through the Canadian landscape. So these are all funds listed on the Canadian market. Again, if you're American, you don't even invest on the Canadian stock market, just skip this part to where I review the American market. So let's start with Harvest, of course, sponsor of this video, a good friend of the channel, HDIF. There's no news on HDIF per se. The distribution has remained the same. The big real news with Harvest is the launch of their new HPYM ETF, which doesn't have much competition. There is MPay from Horizons, which is also a medium-term one, but HPYM is more convenient because you could buy it in Canadian dollars and you get the dividend in Canadian dollars. MPay, you buy it in Canadian, but you get the dividend in US, so it might not be as convenient. And another thing Harvest did that I found was very, very useful is they did a .u version. In case you want to buy it in US and get US dollars dividends, you could get HPYM.U, and they also added HPYT or HappyT.U. So if you want to generate American dollars, you like this ETF, you can now get the .U versions without worrying about the 15% withholding tax, because the .U versions are still listed on the Canadian market. Big news, of course, this month from Hamilton ETFs. They are launching 4 brand new yield maximizer ETFs. The video will come out tonight. Well, as I'm filming this video is coming out Sunday, so the video will already be out discussing these 4 ETFs in detail, so make sure to check it out. Also, big news with HYLD and HDIV. They're internalizing the fund. I also talk a little bit about that in the video, which is going to be released, or was released February 7th, today. So make sure to check that out, and I'm happy to announce that Hamilton has agreed to come back on the channel and do a whole video just discussing HYLD, HDIV, the internalization, the management fee reduction, what does it mean, what could we expect, the distribution increases. Very, very busy and extremely cool month for Hamilton this month here as they complete, I believe, or round up their yield maximizer series with these 4 new ETFs. They almost have every single sector covered. Maybe real estate would be a nice yield maximizer ETF. So note to Hamilton there, we need a real estate one. But yeah, very cool. HYLD, HDIV, a big distribution increase for both of these by 1 cent here. So maybe there's even more to come. So really, really cool. Horizons ETFs, another one of my favorite, Canadian covered call ETF. Of course, they have what I feel are the top 4 funds. They're index-based pretty much, and I love them. USCL, which is pretty much the S&P 500, QQCL, NASDAQ 100, CNCL, the Canadian market, TSX 60. And of course, you have the newer EQCL, which just combines all 3 of those, plus has some growth in the emerging market and international markets as well. And by the way, I did receive some comments where you think I'm speaking too fast. Guys, I gotta go quick because there's a lot of ETFs to cover. I might be separating the series in 2 episodes, one Canada, one for US. But just a note, you could go in your YouTube settings and actually slow my voice down if it's too quick. You could do it, change the normal speed to 0.75. Or by the way, you could even speed it up if you find that it's too slow. So no real news on any of these guys. The distributions declared have all been the same. So USCL's 23 cents. QQCL's 25 cents, I believe. CNCL, same thing. No distribution changes. So these are really great foundational index-based covered call ETFs. These are the leverage versions, right? USCL, QQCL, CNCL, and EQCL. They all have non-leverage versions. So USCC, QQCC, CNCC, and for EQCL, it would be GRCC, I believe. So moving on to Evolve now. And by the way, in case you're noticing, I really cover more the diversified diversified covered call or income-oriented funds in these episodes. I'm not going to focus on all the sector-specific ones unless I feel the sector is undervalued. I talk about it at the end because there's just so many. This video would be 3 hours if I did that. So I'm really focusing on especially the diversified ones here, the ones where I feel are really good core positions to have in your income portfolio. So when it comes to Evolve, it's ESPX and ETSX, which is literally S&P 500 with covered calls. For ESPX, up to 33% of the portfolio. So very, very similar to USCC. I say USCC, not USCL, because ESPX is not leveraged. But there's a bit less covered calls. That's why USCC has like a little over 10% yield, and ESPX has 8.2% yield. So remember, guys, when it comes to covered call strategies, the general rule of thumb is the less yield it has, the more upside you capture, the more capital growth you could have. But the more yield you have, the less growth you capture. So really, you got to make the decision for yourself, which is tailored to your situation. I'm, of course, more of an income first guy, of course. That's why I own, personally the USCL. But hey, ESPX is really nice balance if you like that, up to 33% of the portfolio. It's a great fit. No distribution changes for ESPX, none at all for ETSX. ETSX is obviously the Canadian market, which is not doing as well like we saw. This is why the yield is quite a bit higher here. So I do think the opportunity this month is definitely on more the Canadian market because the financials and energy and material sectors are lagging, but a little bit discuss some of those at the end here of the clip for the Canadian side. Moving on, sticking still with the ETFs. Bitcoin and Ether, of course, if you're interested in that from purpose. No distribution changes as well for these two. Is it a good time to get in Bitcoin? Maybe. I don't know, guys. The halving is coming. The ETF has launched. The price has stayed flat. That's because, people got out of the Grayscale Trust to go into the ETF. So I am definitely optimistic that it will go up. We'll see what happens with the halving. But hey, you never know. It is a little bit riskier. But you could get a really, really nice yield buying BTC Wire. And even the Ether one, which I feel is probably even a little bit more risky than Bitcoin, but both of them have been doing fairly well. They've been recovering a bit here. So moving on to split funds and closed-end funds. Now we kind of covered the ETFs, and again, these are not the only ETFs that exist. I'm just thinking, I forgot the BMO one, ZWQT. I can't believe I forgot to open it, but BMO also has an all-in-one called ZWQT, which, if my memory serves me right, distribution has remained the same. So these, there's more ETFs out there, but I really gonna cover the ones I feel are the top ones. So moving on to closed-end funds and split funds, you have, of course, the king, Canoe EIT, which always, for some reason, usually trades at a small discount. You see that here. It's worth $13.19. Could buy it at $13.04, and they have been changing their asset mix a little bit. It used to be a little bit more Canadian. Now it's actually 50-50. I found that very interesting. And if you go to the top 25 holdings, they always change their holdings a little bit or the order. Remember, guys, this is an actively managed stock picking fund, but you'll recognize a lot of the stocks, right? This is all quality. The way I like to describe Canoe EIT is collection of value, good quality value stocks. And hey, they actually add a little bit of technology back in here, 1.77. I don't know which company it is because this is only the top 25. So I don't know which technology stock it is, but my guess would be Microsoft. You could probably check it out if you go in their documents, but not going to go into that level of detail. Still the king, EIT. Guys, always good fun to buy, especially at a discount here if you know how closed-end fund works and you're okay with that. Moving on to split shares now. We're, of course, going to check the Brompton ones first, which has, in my opinion, one of the best websites because you could kind of see them all here in one shot. So there are still some good discounted Class A shares. PWI and LCS, guys, are still trading at discounts, right? You could buy them at $6.64 for LCS, which is just the 4 top big life insurance companies in Canada. Nice 13.5% yield. But it's worth, the value is $6.81. PWI, it's even bigger. The discount margin, you could buy for $6.26, but it's worth $6.70. So if you like those two sectors, you don't mind a leveraged investment, you understand how split share funds work. They're really good to consider. Even GDV, the discount is really, the premium is very small. It's a 5% premium, more or less. You could, it's worth $8.73 a share, but you could buy it for $9.20, so you're paying a little bit more than what it's worth. But guys, I've seen GDV trade at 20, 25, 30% premiums in the past. Now it's 5. GDV is definitely the most diversified and one of the best, in my opinion, split share funds out there with a very, very strong unit NAV of almost $19, which means it's very, very unlikely that it won't pay. It can though. So a very good option. DGS still a fantastic option, almost on par here. And just like I discussed with Michelle and Chris in a previous video, which I suggest you see, DGS historically 80% of the time trades at a premium. Now it's pretty much trading on par. So it's still a great time to buy DGS if you're looking or don't mind a leveraged investment in the overall Canadian market. You see here, you could buy for about $5.21. It's worth $5.30, so just a tiny premium. And hey, if DGS keeps paying or doesn't go under that $15 unit NAV, you're actually making a 23% yield. But again, you got to make sure you understand how split share funds work. If the unit NAV, which is the net asset value of the Class A and the preferred share, is under $15.10, it will not pay the distribution. It's not that it's a bad thing, but I'm not going to get into it, discussed it. But you see here, the unit NAV is $15.40. So, hey, I mean, if the Canadian market stays flat or keeps going up a little bit, especially the financials and energy, which have lagged, so they could recover. You could book a 23% distribution yield, which is fantastic. Middlefield has two split share funds, the ENS, which is Enbridge, and RS, which is real estate. Never missed the dividend. Really, really good. Premiums are fairly high, though. I think they're over 10% for both of these. So I would say not the best time to pick these up right now. But hey, if you're a fan of Enbridge or real estate, you could still pick them up, because I personally never seen these trade at discounts ever. So Quadravest, they did update their website as of the NAVs as of end of the month. And you see DFN here, 1502. So I don't know. I don't think it's going to pay. It has to be 1510 to pay. But there's still a few weeks left in February. We'll see. So if you compare DFN, by the way, you might be asking, well, why is DFN maybe not paying and DGS started paying? DFN is a lot more concentrated in financials than DGS is. DGS is much more better diversified than DFN, so that's probably why. FTN, all financials, about half America and half Canadian financials. I own this one personally, actually bought some more of it. You'll see that in the next portfolio unveil. I explain why. But pretty impressed with this one. It might be a good time to pick it up because the net asset value is about $7.35, and I think FTN's trading at 760 or something like that, 770. So good time to pick it up, and pretty not super far, but not really that close to that $15 unit NAV threshold. BK is just the Canadian banks, very high unit NAV of about $20, or the Class A shares at $9.65, and I think they're trading for about $10, 10 something. So definitely at a premium, but smaller than usual. So things like BK, LBS, SBC, they typically trade at big premiums, but now they're much smaller because the financials, especially on the Canadian side, are suffering. So you got a lot of choice when it comes to the Canadian financials, right? And this brings me to which sectors I feel are undervalued. Definitely more on the Canadian side. So on the Canadian side, overall Canada, but really financials. I would even say energy has gone down as well. Maybe some good time pick up ENCL or ENCC if you don't want the leverage version. I mean, ENCL has like 19% yield now. Absolutely insane. I was really thinking they would have reduced the distribution a little bit. Maybe they'll do it next month. But even if they do, I mean, we're looking at definitely over 16% yield, even if they do reduce it. So oil and gas, oil prices have taken a hit. So good time to get in something like an ENCL. And now you actually have EMAX too. EMAX is, there's NXF as well, but EMAX is very interesting. It's only oil and gas companies, whereas ENCC, ENCL, it's oil and gas companies and pipelines only in Canada. EMAX is mostly the US. So we got a new covered call energy option now with EMAX. Very, very interesting. And again, I'll talk about it in the video that's being released. That was released on February 7th. So yeah, I think oil and gas, the energy sector, is down. It would probably be a good pickup now. Even gold seems very interesting now. GLCC, which also has a new competitor now, AMAX. There's also CGXF. AMAX could be very interesting, but I mean, unfortunately, there's no GLCL. I wish Horizons would come out with the leverage version. They have leverage versions for all their covered call ETFs, except for the HGY. I don't think they'll do one, but GLCL, I mean, I don't see why they should be a leverage version. Could have over 15% yield or something. So gold producers look juicy, guys. Gold looks juicy. Energy looks juicy. And of course, financials, Canadian financials look juicy as well. And I have a video you should check out where I go through, I'm not going to go through all of them. There's a million Canadian covered call ETFs and split funds. I go through the ETFs here. In this video, when it comes to split funds, you got BK, you got FTN, you got LBS, you got SBC, and there's other ones as well. So make sure to check out this video if you want to get into the Canadian banks. I break down all the great ETFs here. And even Tesla, I have to mention Tesla, YTSL. Tesla took a humongous beating lately. Now is a great time to get into YTSL. Look at that yield, 27%. Keep in mind that the distribution could fluctuate like I discussed with Mr. Nick Merch, but not by much. So I actually, you'll see that as well, picked up a few shares of YTSL as well. But of course, if you're an Inner Circle member, you would already know that. If you're interested in joining the Inner Circle, guys, it's only $3 a month, a lot of perks. Click on that little join button next to the subscribe button. Also, if you like this kind of update, if you're a member, I unveil or I do a opportunity report every single Friday morning, which is kind of like giving you the news like I'm doing now, but more condensed, and I go through the split funds and which ones are trading at 10% premiums or less. So if you like this type of update, you'll love the opportunity report. And hey, membership's only $3 a month. Try it out for a month or 2 or 3. Worst comes to worst, you just cancel. You'll lose $10, for 3 months worth of trying it. I highly recommend it and try it and would try it. So that's the Canadian landscape. So, what's undervalued, I think, is really materials, energy, and financials, which I gave you the funds that you could capture on. And big month for Hamilton with those 4 new launches as well. Harvest is also launching HPYM, which I stay tuned for a video. This could be a great place for very, very conservative investors, maybe even an emergency fund. It would be a good ETF, in my opinion. Maybe some people will disagree, and you could get a really nice 8% yield, which is pretty much mostly all going to be capital gains in Canada. So very, very cool, very convenient if maybe HPYT or Happy Teas, the duration, because it is long-term bonds. You think it's a little bit risky. Well, now you have a medium term, a much, much less risky one with HPYM. All right, that's it. Let's check out the American market now. All right, everyone, time to check out what's going on the US market, which is very, very, very busy. A bunch of new high yield funds have come out. I will cover some of them here. I will definitely, if I feel that they're diversified and they're good hold forever core positions, I will mention them every single month and keep an eye on the ones I feel are the best. But US market has a lot of action. I know many of you have been messaging, what do you think about this one? What do you think of this new fund? I'm going to get to all of them and maybe have a video out for all of them, but I like to wait at least a few months for a couple of distributions to be out. And I also wait for the fund manager. I always reach out to them to see if they want to come on the channel to discuss the fund. So have patience, guys. But, to go in deep in the new funds, but I'll mention a few of them here, a lot of the new ones here today. Of course, we're going to start with the OGs, the ones that are not new, JEPI and JEPQ. Well, JEPQ is kind of new, but JP Morgan isn't, obviously. So JEPI and JEPQ, not much news except for their latest distributions have been much lower in this month. And not a surprise because volatility is really low. Remember, guys, these distributions will really follow what the VIX does. For JEPI, it's more the S&P 500. For JEPQ, it's more the NDX. But even the NASDAQ a little bit less volatile, and you see the little drop in the distribution. This is nothing to be worried about. It's 100% normal. You got to expect varying distributions. It's got a new competitor by another big bank, Goldman Sachs. Horrendous website, but still got it covered because now we got quite a few distributions here. They added a distribution tab, thank God. So GPIX, I would say, is very, it's more the S&P 500 one, and they have GPIC, which is really the NASDAQ one. So these are literally S&P 500 index, NASDAQ 100 index, kind of like JEPI and JEPQ, but JEPI, JEPQ don't actually have all the indexes. They stock pick within. This is, from what I've seen, the actual indexes. So they are very, very interesting. Even has a lower management fee at 29 basis points. You see that the gross is 35. Right now it's 29. So anytime I see 35, I always think they're trying to compete with JEPI and JEPQ, which I'm sure they are. So the latest distribution is not on their website, so I had to go to nasdaq.com and look at it, and pretty impressed. I mean, they're relatively stable. I thought for sure the GPIC one would go down because volatility was lower, but no, it stayed relatively similar. So the yield is actually higher than JEPI, 8.41. So pretty impressive. GPIC, same thing. Relatively stable here, actually went up, which very much surprised me. And it's the NASDAQ, so you could always expect GPIC to have a little bit more higher yield than GPIX, just like JEPQ should always have a little bit more yield than JEPI, right? Because the NASDAQ 100 index is more volatile typically than the VIX, the S&P 500 index. So yeah, pretty interesting stuff here, 8.41. And 10.38, definitely got to we'll keep an eye on. I'll cover these every month now because I do feel these are really, really good core positions to have in an income portfolio. And speaking of other core positions, SPY, of course, S&P 500 from NEOS, very nice high yield, a little bit higher than the Goldman Sachs one and JEPI. You're looking at about approximately 1% yield a month, which is phenomenal. It's been doing really well. It's growing. It's really, really popular. And of course, they just launched QQQI. This should be no surprise. Troy from NEOS messaged me about it, that they're launching QQQI, which is basically SPY, same concept, same strategy as far as I could see, same management fee, but it's on the NASDAQ 100. First distribution has not been declared, but if SPY typically gives 12% annual, 1% a month, I do expect QQQY to have a little bit higher. So it'll be very interesting to see. My guess would be something along the lines of 13.5% yield instead of 12. So super interesting. We got so many now. JEPI, JEPQ really got a lot of competition. So a lot of great index-based funds, which I feel is always the best way to go, at least to make core positions. And how can you go wrong with the S&P 500 or the NASDAQ? Speaking of S&P 500, another one adding to the list here. And by the way, in case you're not noticing, I am going crazy because this video is getting way too long. So I am announcing now that I will be separating the monthly picks video into two separate videos. One for the Canadian market, one for the US market, and I'll probably just release them on the same day at the same time. So I don't, so I could actually take a break in between because I like to just film these as I go. So ISPY, this is a brand new S&P 500 covered call ETF by ProShares, and it's daily options. It uses daily options like the Defiance ones, but they seem to be a little bit more modest. I mean, the first distribution was declared. We only have one distribution to go by, 48 cents. So if you do times 12 to get the annual and you divide it by the current stock price, it's approximately 14% yield. So higher than SPY. Management fee is really, daily options means more work than the monthly, but they did a good job of keeping it really low at 55 basis points. Compare that to 99 from Defiance. But Jay is not managing this fund, right? I don't think so anyway. It's going to be ProShares, bigger company. So definitely got to keep our eye on this one. This might be a good S&P 500 core position and might be even one where you could live off the income as well. JEPI, JEPQ for sure. The Goldman Sachs ones for sure. SPY, QQQY, I believe so. QQQY, JPY, which we'll see in a second, I don't think they're designed best to live off of, extract all the income. But maybe this one is, and you could get 2 points more of yield or more yield than a SPY or the other one. So very interesting. Maybe they'll come out with a NASDAQ one. I don't see why not if this one gets popular. And another new one to the game is BlackRock. BlackRock has joined the game along with Goldman Sachs and JP Morgan. And I know they're competing because look, again, the management fee 35, just like JEPI. So Bali, this is one I would compare to JEPI. This looks almost like a JEPI replicate where they pick and choose stocks. It's actively US large cap exposure, so big cap US stocks. It's not the actual S&P 500 index like the Goldman Sachs one or SPY. It's more like JEPI. They're picking and choosing stocks in there. And they're doing covered calls. So it really looks like JEPI to me here. It's from BlackRock. And the yield is about the same as JEPI, maybe a little bit higher. I mean, this is brand new. It's growing very quickly at 21 million here. They declared the first distribution. Now you see here 7%. So it's about 7% yield. So this one looks like, a JEPI copycat to me, but we got to keep our eye on it because this would qualify as a good core position. Another one from Morgan Stanley, PAPI, the Parametric Equity Premium Income ETF. This one, after looking at it, and again, I'm going to have probably a video discussing a lot these new funds in detail. This one looks like a copy of Devo to me. So Devo is really one that's stock picking in the S&P 500 defensive stocks. There's a lot less stocks than in JEPI, and they only write a little bit of covered calls. So the yield is actually very low on Devo. It's like 4 or 5% here. You see very low. This one here, the first distribution was declared. I did the calculation. Three of them have been declared. You see here that they could vary. It makes sense to me that the latest one is lower because the VIX has been a lot lower. But this one looks very similar. I think it's like 5 or 6% yield. Very similar to what Devo does. Maybe just a little bit more income than Devo. So I know you guys are like, well, listen, there's so many choices now. Which one do I choose? Well, you got to choose with the one that works best for you. And what I could say, the easiest way to maybe assess these is, yes, you got to look at the management fee and the performance, but performance, some of these have only been out for a few months. Just remember, guys, the higher the yield is, the more the more capital appreciation you give up when the S&P 500 or NASDAQ goes up. But the opposite is also true, right? So if you're getting more yield, those will tend to do better when the market is flat or down. Problem is the US market always tends to go up a lot. So A lot of these are great to live off of. All of the ones I've mentioned, I think, are great to live off of. Now we have QQQY and JPY. These are the ones that I own on drip in my retirement accounts. Did a video on why they're not feasible to live off of. If in case you haven't missed it, I interviewed Jay. We talk about these funds in a very, very recent video. And QQQY latest distribution has increased a lot. That's because volatility has increased a little bit on the Nasdaq. On the VIX, it's on the S&P 500, which is the VIX. It increased only a little bit, so there has been a little increase. And remember, guys, these are varying distributions. I talk about it with Jay in the video. Make sure to check it out. And he confirmed 100%. It's 100% based on volatility, right? So these could vary greatly. They also have the Russell one, by the way, IWMY, in case you want the Russell 2000 index, which is a small cap, small cap section of the U.S. market. Moving on, SVOL. By the way, what was the distribution? I think it was a bit higher. Yeah, it was 129. So the Russell obviously was very volatile. Very nice distribution there. Moving on to Simplify, SVOL, my favorite alternative style. I think this one is really amazing. It's growing. It's almost at 700 million. Good news is it just declared their normal 30 cent distribution. I think it's relatively going to be very, very stable at 30 cents. Watch, and if you own SVOL, make sure to watch my latest video on it, where I talk to the creator of this fund, the guy who manages it. We talk all about it. This fund has actually gotten safer, not more risky. And you see that they added 2 of their ETFs in here, because VIX, the VIX premium you could get has been lower. So they made some changes to be able to sustain a 15% yield. The goal of SVOL is to give 15% yield, guys, with the most stability possible, and it's been doing fantastic. High, a little bit similar to SVOL without the VIX exposure, so it's going to be much safer, much more stable, but you're going to get a lot less yield. You're going to get about 10% yield. Doing really well. Also declared its usual 20 cent distribution, so I'm fairly certain it's going to be 20 cents going forward, which is about 10% yield, which is good. YieldMax, of course. YieldMax, they just declared their distributions. You see the new distribution rates based on the latest distribution rate here. YMAX came out. This is really the one that excites me a lot. If there's any one I'm going to buy, it's probably going to be the YMAX one. No first distribution yet. That's going to be in the next cycle. As I discussed with Jay, there's always going to be a delay with the YieldMax. But YieldMax, they're doing exactly what they're supposed to be doing. This is to get maximum yield. Like the name says, harness maximum volatility. But now we finally have an all-in-one, which of course is going to be much less risky than just getting a single stock one, because you have exposure to basically all the YieldMax ones. And if there's new one that come out, they're going to be added into YMAX. So again, make sure to check out that Q&A I did with Jay. A lot of you have been asking about FEPI. FEPI is one of the only sector-specific covered call ETF in the US that's actually worth looking at. It's doing really well. It's about 25% yield, top 15 tech stocks. So I might have a video just covering this, but this one's doing really well. If you really love technology and you're okay to concentrate on just technology stocks, instead of getting something like the NASDAQ 100, which you could get QQQY and this one here and JEPQ. If you really love tech, you want to go all in on it, FEPI is a great option if you're an income investor. Really good ETF here. Moving on to the fixed income stuff now. The fixed income stuff, you have TLTW, you have LQDW, and HYGW. All declared lower distributions than last month, but that it's normal to have varying distribution. Which one's doing best? The one I suspected would do best, and I was right, even though it has the highest fee. It's this one, HYGW. And I think it will continue to do the best because the high yield corporate bond ETF does better than the investment grade ETF, which does better than the government bond one. So the covered call version, it would be the same thing, right? So you got these 3 from BlackRock. You have this one, very interesting, kind of an all-in-one fixed income solution if you don't want to choose. It's AGGH from Simplify. This would be a really good option if you just want, I just want a core bond exposure with enhanced yield. This is a really interesting one. I talked to Sailesh about it in the SVOL video. Make sure to check it out. AGGH is a nice big exposure in SVOL to get that nice yield up. You see 16% here. Really good, if you're in the market to get some core fixed income or bond exposure, AGGH is definitely one to consider. Over 10% yield, I believe, monthly payout. And we got a new one, Trez from Defiance. People have been asking me about it. So it looks like it's going to be a very, very boring one, but with, very similar to AGGH and similar to TLTW. I believe they're going to write options and cover calls on boring US Treasury. So I don't know what the yield is going to be approximately because the first distribution is not out, but you'll see it has mostly TLT in here, and they'll probably write calls or do option strategies on TLT. So I expect this yield to be lower than obviously the index ones, but I expect the share price to be much more stable. Then you have Maxi if you're in Bitcoin. If you're into Bitcoin and you're an income investor, now obviously there's a million spot Bitcoin ETFs on the US market. That's pure Bitcoin exposure. But if you want some income, I love Maxi. That's just my go-to because I'm an income investor. Maxi is basically Bitcoin exposure with highs strategy. That's what Maxi is. And again, discuss that with Silesh. Moving on to closed-end funds, the only real one I want to cover, and I'm not going to cover that many going forward when it comes to closed-end funds. CLM, very, very small premium. Might be a good time to get into CLM because the premium is really, really small. I don't think I've ever seen it at 4.33%. So it's probably a good time to get into it here. And of course, my personal favorite is Riv, which is like an all-in-one closed-end fund solution. Still trading at a discount, 7%. It's been doing really well, recovering well, and I think it will continue to recover well. And when rate cuts happen, I think it's, the fixed income market is going to go much, much higher. So I love Riv. I'm just buying more shares, just dripping away, buying more shares at the discounted market price. So that's it, guys. I'm out of breath. I can't keep doing this. I'm going to have a heart attack. Next month, 2 separate videos, one Canada, one US. Hopefully they'll be about 20, 25 minutes each, not more than that. But it's busy. It's busy, especially on the US market. A lot of funds. So I'll eventually cover all of these. Don't get too overwhelmed. Remember, a lot of these, especially the ones at the beginning here, and I did the order on purpose. They're all index based. They're all S&P 500, NASDAQ 100, just different option strategies. So it's about finding which one works best for you depending on your situation, but more on that kind of stuff to come, go. So thanks for watching, guys. I really appreciate it, and we're going to do this again next month in a more efficient way. See you. Hey, don't go yet. A few reminders before you leave. Did you know that I launched a YouTube loyalty membership program where for only $3 a month, you could become a PII Inner Circle member, where you will gain access to exclusive content, exclusive videos and live streams, as well as other perks and benefits, including a really cool weekly opportunity report. That's right. If you're interested, just click on the little join button next to the subscribe button to see what it's all about. Also, make sure to follow me on Blossom and download Blossom. It's a social investing app, which is really cool. You could share your portfolio, follow other people's portfolios, including my own. My username is Adrian_PII. So download it with the referral link below. Not only is it free, but you could actually earn cash by taking these really small, quick 1-minute courses. Really awesome. It's a no-brainer. Also, make sure to visit our website, passiveincomeinvesting.ca. That's where you could book a one-on-one private coaching session with yours truly, with myself, where you could ask me all the questions you want. All the information and booking information is on the website. Make sure to check out that video on the homepage there to see how to book a one-on-one properly. Also on my website, you could purchase my digital product, which I'm very proud of, the ultimate DIY investing package. This is a reference tool or a companion tool that will help you build your own portfolio. So it has lists of funds, it has sample portfolios, and it covers both the Canadian and US stock markets. And the good news is you'll only ever have to buy it once because it comes with free lifetime updates. And my plan is really to update the version every single year. So make sure to pick it up. Also, I have Questrade and Passive referral links below. So Questrade is the broker that I personally use, and Passive is the broker companion tool or assistant that I use. Really cool program, really cool software. So I have referral links for both of those. Questrade, $50 of free trades. And Passive, I have half off for the Elite membership. If you're interested in the Elite membership, and even if you want to start out with the free membership and upgrade to the Elite afterwards, use my referral code so you could still get that 50% off. And don't forget that the Elite membership of Passive is 100% free if you use Questrade. For social media, we have a very successful and big Facebook group, private Facebook group with over 14,000 members where we all try to help each other out. So make sure to join that group. Information is below. We also have Instagram where you could follow us or more personal stuff when it comes to our life here in Panama. And there's LinkedIn as well. So as usual, everyone, how do I leave you? Continue to stay safe, stay healthy, and of course, stay passive. See you next time.